Hi guys, welcome back to my channel. Kelvin here. So for this episode, I have a special guest. His name is Jonathan Ang. He has a YouTube channel called Invest with Jang. Can you give a quick intro about yourself?
So I'm actually a growth investor and I'm currently investing full time. So I kind of like focus on growth stocks and I do a YouTube channel to share about my stock ideas and my stock trades pretty transparently. And I like to really dive deep to the financials of a company. And I also like to interview CEOs if possible so that I can really double down and build a very confident position because my portfolio is rather concentrated.
In short, are you a stock expert?
Yeah, so actually Kelvin, you really stressed me a lot, like initially when you put on your community channel you're going to invest in a stock guru, I'm like no. I'm definitely not a guru. I mean, I don't claim myself to be a guru, but what I do is that I really share whatever experience I've gotten through like losing money in the stock market. Because I started when I was 18, now I'm 26. So over the 8 years, I've learned a lot from my mistakes and also from mistakes of others, and then I share it. So definitely I'm not a guru, but I like to share some of the learnings or some of the insights I'm getting from people on the internet. So I think if someone say that they're a guru, I think you should run really far away from them.
Is there any particular year that you start to become better in investing?
You know, when you're 18, right, when you learn things about like value investing, it's nice, it's very good. But you don't see that returns, and then you see your other friends who are doing like day trading, futures trading, options trading. They're making like 100% in a day, and it's really possible, but it's high risk, right? So I tried those. Maybe on one day I can make 100%, and then I lose all, and I felt very frustrated, right? Because even though I made money, but I couldn't keep that gains, right? So in a way, my portfolio was always up, down, and eventually I did a review. I didn't really get to anywhere. So that's where I really wanted to find out how are people really consistently making results. Then I met Kelvin, which is kind of like my business partner now. And then I found out from him about this method called growth investing, right? And that was where I realized that a lot of people who are in the Forbes top 10 richest, they are either long-term investors of companies or they are founders of a company and they have held shares for a long time. So one example is Tesla, right? Elon Musk started his company like 10 years ago, and even though it IPO'd, right, but he didn't sell any shares away. So that's how he got really wealthy.
Until recently.
That was where I realized, wow, actually the formula is really right there, right? Statistically, all the top 10 richest people, they are all owners of a business. Even if they are not, they are investors of businesses. And that's where I really wanted to treat long-term investing more seriously, because I don't see any option traders, day traders on the Forbes top 10 richest list. So I'm a very statistical guy. I studied engineering in school, and I'm supposed to be a data scientist. That was what really gave me that epiphany and to double down on growth companies.
So the stats are there lah. Even though most people at the start, they like to day trade for whatever reason, but day trading is not sustainable long term. Right now, what are the top 5 investments in your portfolio?
I would say like the stocks as a whole is a bit unconventional because I invest more into like small cap companies. So the companies I invest are around 20 billion and below. So my top 5 holdings are, I think, is quite transparent in my channel. So I have Fastly. I also have Pointera. What they do is that they do 3D data and they help utility companies to detect a forest fire before it comes. I also have this company called Camplify. It is on trajectory to be the next Airbnb for RVs. It's very huge now, especially during COVID. And even during COVID, right, when Australia was on a lockdown, they could still grow at 100% in terms of their revenues. I invest in Nuvi. I think the world is moving into the EV space, right? More and more people are going to have electric vehicles. More and more people are going to consume electricity. In the US, right, during winter, actually there's a power shortage. Okay, imagine like it's like -5 degrees and you don't have electricity because you can't heat. A lot of cities are actually overwhelmed. Even in Singapore as well recently, they actually started becoming involved in creating electricity. So it used to be a privatized market, but now they are actually getting involved in it. So I think power shortage is real because more and more things are starting to use electricity, especially when the world is going to move in the green space. And Nuvi is a company that helps power companies to alleviate that and to help to lighten the load on the grid. So actually these are the top 4 main positions, but the rest are just like not a huge percentage of my portfolio.
I think the reason you are investing in very small cap companies is because they have a potential to more than double in the next few years.
Correct. So I think, for example, like if you have a market cap of $1 trillion, for you to double, you need to increase by another 1 trillion. But for example, like Nuvi, it's only a 200 million market cap company. So for it to double, it just needs to go up by $200 million. So that's why I'm more interested into like micro caps.
Do you invest in Tesla?
Actually, I didn't invest in Tesla. Because I was late into it, I didn't feel energized to actually go into it. So I think there's a lot of like price anchoring bias there. Right? Because when you see a stock price go up, then it's like, you feel like, oh, you don't feel like buying. But actually, that's a mistake. Sometimes I always tell people, for certain companies, you have affinity to it. but for other companies, you may not have affinity to it. For some people, Tesla is something that's very interesting, but for me, maybe that drive is not really there. And I think that's okay because there's always opportunities in the stock market.
Just now, when you mentioned the 4 stocks, right, I have to admit, I haven't heard most of them. How do you find these kind of stocks?
There's a lot of small cap forums, and also I do follow some YouTube channels that actually talk about IPOs. So mainly on Twitter. I think Twitter is actually a very good place to actually source out for great ideas. That's where I got to know about all this company.
When you invest, right, what are you looking at in the company?
So actually I'm quite, in a way, stringent, right? Especially for smaller companies. For your like few $100 million company, right? I think it's very important for me that the founder still has shares in the company. So preferably more than 10 to 20%. If the stock tanks, right, I will not be the biggest loser. The founder will be the one who has skin in the game. He will be the biggest loser. We are both aligned. Because when I invest in a company, I see myself as a partner. I feel more comfort, right?
Okay.
As long as he holds on to the shares, I feel that he's incentivized to work harder to make the company perform better. I think secondly, I want to find a company that has a huge circular tailwinds. Yeah. So for example, Nuvi is in the EV space, just like Tesla, and I think the EV space will take off in the next few years. Pointera is actually in the space of 3D data. You see companies like Unity, even like Facebook change their name to Meta. So I think there's a huge space in that 3D industry. You know, if you're a small fish in a big pond, and that pond is going to get bigger, even if you are just an average company, you should grow together with the industry. So that's kind of like a margin of safety that I have for myself. And of course, I think revenue growth is very important for me. So for example, like Camplify, they are only 1% penetrated in the whole Australian market. The potential to grow is really huge, and they've been growing their revenues at around 100%, growing their bookings. So seeing this kind of growth rates really excite me. And if you buy these companies at a great valuation, then it's really not hard for you to hit more than 10 to 15% returns every single year. I'm just being very conservative here, right? And I think lastly, definitely valuations. Like I think it's very important not to overpay. That is why for Fastly, I only started buying it when it went all the way down to $40, because even though it had management issues, execution issues, I got it at a low price. So I feel that if it goes any lower, right, it is just ridiculous. So I think valuation is also very important.
The reason I don't invest in small companies is because I'm afraid that he has a lot of competitors. Let's say if you invest in Neo, then you have Tesla to deal with. How do you deal with this kind of issues?
For small caps, right, the very amazing part is that they don't have to be leading companies, because some of them are like 8 to 10 million revenues. That is why it's very important for me to invest in a pond that's increasing. When I invested in this company called Pointera that manages 3D data, right, so what they do is that they send drones, right, to actually take all the 3D map. They map out all the power lines that a utility company has. And then they will look at the vegetation, and from there they will put all these images into an AI software, and they will find out where are the high key risk areas where your trees are touching your power lines and it may cause a fire. It does seem to be like what Palantir is doing. And when I called the CEO, I asked him like, how do you think you compete against Palantir? So basically what they do is they are so niche. Big companies, for example, like Microsoft, you have tried Microsoft Teams before, it's just a nightmare, right? Like, you know, when you want to do video calls, it really sucks. I hate the UX. But when you compare it with Zoom, why is Zoom able to do a better job? Because they only have one job in the world, and it has to make a good teleconferencing solution. So I believe what these small companies are doing is that they are actually identifying a very niche area which they can excel very heavily on. That niche itself is big enough for them because they're so small, right? They're 8 to 10 million revenue only, and for them to go to 100 million revenue is not hard because the TAM is huge and they focus on that niche. So for example, for Camplify, so basically it's peer-to-peer, right? If I have an RV, I can rent it out on the platform, and then if you, let's say you want to go Australia for holiday, you can rent the van for me. Existing platforms, right, they were not doing a good job, and it was very painful for someone to rent an RV, right? And then you have things like cancellation. Imagine like you book a holiday, you have kids, right? You take 1 week of leave, and then you go there, and then you get cancelled last minute. You have no other alternatives. It's going to be very painful for the customers. So what they do is they identified this niche, right, and they make it so well. They make the customer experience so well, and they also brokered insurance with the insurance companies, because I think the huge thing is damages, right? For example, like if you rent an RV and then you damage it, right, and then you don't pay out, it's going to be very demoralizing for me as an RV owner, right? It's like I rent out, then in the end I get more problems, and myself I don't rent. So Camplify actually assists all these owners by giving them a good insurance and at the lowest cost as compared to other people.
Summary, right, you are looking at the growth opportunity and not so much at the competition.
I do look for competitors, but if I see that the competitors are not really very niche because they are so big, right, and they don't have that energy to really dominate in that space, and I see that small company having right product market fit, that means it's not like as if the CEO say, oh, we're going to beat Palantir in this, and then I believe them. But rather, I see that they really back it up with real growth numbers. Yeah, so for Pointera, they've been growing 200% in terms of their revenues. Because it's a very small company, small base, right? So they started off with like, I think, less than 1 million of contracts coming in, and then now they're around 10 million in value of contracts. So that's about 10x. I was monitor the execution, so I'm not the kind that will go in when they are at pre-revenue stage. That means I won't buy a company when it's zero revenues. Even if I do, it will be lesser than 1% of my portfolio. Then that would be a very calculated bet, but chances of them failing is very high. If you have management that execute maybe from 1 million to 2 million to 3 million to 4 million consistently, then you get some sense of like, hey, they're executing well. Yeah. So how do I protect myself is that I don't go all in. Like I always like to say, just like dating, you meet a girl for the first time, right? You don't kind of like hold their hand or try to kiss them in their first day. You want to get to know them slowly, develop a relationship. So it's the same for small cats especially. Right. So I want to see them execute over time, and I buy in tranches.
So how many hours are you spending per month doing this?
For the first purchase, right, I usually spend close to a month. For me, right, if possible, I want to speak to the CEO. For example, for Camplify, we spoke to the CEO. For Nuvi as well, we secured an interview. And for Pointera, 3DP, we also secured an interview. So because it's so small, right, you really want to ask certain questions. Because I think for some CEOs, like when you ask certain questions, right, if they don't really have a plan and they are smoking you, then you can kind of tell. For example, if they give a 100 million target, I'll ask him, how come you're so confident? Like, bring me through like your mental model, right, and break it down into unit economic. This business segment, how much you plan to do, and let's say, for example, for Camplify, let's say we want to keep 10 million revenues, right? How many hirers do I need on the platform? And how many owners do I need on the platform? So I really break it down to the numbers, and then we actually look at their Facebook group. They have a Facebook group for RV owners, and we see are these numbers increasing. So it's a lot of very unconventional methods to really make sure it is on track. For e-commerce companies, what we do is that sometimes we'll purposely buy a product because they actually have a receipt number, like order number. For example, order 1001, and then if another person buy again, it's order 1002. We start the year, right, maybe in January, we'll buy something, we look at the order number, and then 3 months later we buy something, and then we see what's the order number. So we can see how many orders are made, and then we make a rough estimate what's the average order value. So it's really very intensive, and that is why it's very hard to own 10 companies, I would say, if you want to do stock picking, especially for smaller companies.
Just now when you say you were interviewing CEOs, you were able to do that because you have a platform, you have a company, so the CEO bothers to reply you.
Actually, the surprising thing is I always thought it was like that. I think sometimes if you can ask really great questions, right, so I always email them and share certain things that I like about the company. It shows that I actually bother to read through the earnings call, I actually bother to understand the company. And then I ask some preliminary questions that show that I really do my homework, and it's very unique from other analysts. Yeah, so from there, they will actually be bothered to entertain you. And I think, of course, it also helps if I say I have a YouTube channel and I plan to actually do a video of a company, right, to share my thoughts. And I want to know more details before I can actually be confident about the company. And then I think it will also help to say, like, I mean, this is a tip, huh? If you say, I've invested 80% of my family fortune into your company because I believe it can grow, and then you list down the reasons why. And sometimes I will actually list down links of their interviews they did 3 years back to show that I actually made an effort to plow through every single thing that I can get my hands on, that I'm an educated investor. So they do entertain, they do like to talk to people. Yeah. And it also helps for them because when more people understands about the company, more investors will know about it, and then they'll get a more fair valuation.
After buying the stock, right, when do you decide to sell?
For me, right, it's all about weighing out the opportunity cost. For example, like if I find another company that's growing at 200%, I'll definitely look at my lowest grower in my portfolio and I'll eliminate it. But as much as possible, I hope not to sell. I mean, I always try to think myself as a real business owner because that's what we really are, right? We invest in a company, we are a real business owner. And then I ask myself, if I were to really invest in a business in real life, right, you're not going to get out of a business in 6 months or 1 year. Most people invest in a real company and want to be there for like the next 5 to 10 years. Actually, you don't really need very high growth, right? Maybe if you compound money at 20%, you can actually be very, very wealthy. That's one, when I find a better opportunity, that's when I sell. Secondly is when the fundamentals erode. Let's say news of potential fraud, and I'm a bit uncertain, I could potentially lose like 50 to 80% of my money because if there's a fraud, it's just like Wirecard. What happened to Wirecard back then? Like the stock just tanked 90% overnight. I mean, it's okay to miss out on that 10-20% gains because I think when you start thinking long term, right, you want to not just make money, but you also want to stay wealthy, right? You want to keep your gains, right? Rather than you make money, then maybe next month you lose your money. Then you'll start to be a bit more conservative, be a bit more safer. So when there's uncertainties like fraud allegations and everything, it's good to sell.
Right.
Yeah, because if you lose like 70% of your money, you need to make about 200% to go back to break-even point. Yeah. It's very hard to get back to where you are. Yeah.
How do you stop itchy fingers? Like, let's say you saw his Tesla goes up from 800 to 1,002. New investors, their mentality is buy low, sell high. How did you transition from buying low, sell high to buy low and hold all the way?
I think there's no way to address itchy fingers unless you have like a itchy fingers portfolio. Or what you can do, right, is that I think because you share about options, so I'll just share because I think your audience is more advanced. Let's say you have itchy fingers, Tesla goes from 800 to 1.1k. You can actually sell a call at 1.1k strike price. And if you're okay to get caught, right, you get caught, right? But the thing is, you get to earn the premium. So in a way, you can actually earn some money from that gain. But I think it's going to be a huge opportunity cost if Tesla goes to 1,005, and because of that few percent of premiums, you sell a call.
But if he has a smaller portfolio, what do you recommend?
Why I had itchy fingers was that I was actually very free, right? I was actually looking a lot at my portfolio. I was trying to optimize it. But I realized that when your portfolio is small, right, by trying to optimize your portfolio for the short run, right, you're actually not moving much of the needle. So let's say if I have only a 5k portfolio, and then I managed to boost my returns from 10% to 20%, right? That's an increase of 10%.
Yep.
So that's only $500. So I might as well go and do a side hustle and focus on a side hustle.
Right.
And then I just don't check my portfolio. I just leave it there, let it do its thing, right? Don't sabotage it. One mistake I made was that I kept trying to do too many things. Then in the end, I go back to square one,
right,
where I look back, right, if I just did nothing at all, I could have been so much better.
Yeah.
And if I could just earn more money and put more money, I would have grown my wealth so much faster. For people who have 400, 500k portfolio, right, if you can increase by 10%, then that's huge, right? Because let's say if you have 500k portfolio, that's like 50k. I think for these people, if they want to be full-time investors, they want to optimize it a bit, I think it's fine. Yeah, so I think my advice is really just try your best not to scratch your fingers when it's itchy. One thing is maybe you can channel that energy to something that you like and you can monetize. I think that's like the dream, right? If you can monetize your passion and then move that, when you earn money, move that money to your portfolio, then somehow, because when you like what you do, like time passes and then like 1 year later you look at a portfolio, wow, my god, like I never even touch it and it's grown so much.
Yeah.
I think that's a like really best ideal scenario.
What do you think is the best way to go from 100k to 1 million?
I think for listeners, I have to say just buy Tesla. If you were to look at it over the next 5 years, that means you need to compound your money around 30. Okay, I can't do my math right now, but definitely 30 to 40, 50%. For that to happen, you definitely have to find companies that can grow their revenues at least by more than 40%. Because I think in the long run, right, the rate at which the company compounds internally is going to be the rate at which their stock price compound in the long run. So in the short run, maybe the stock price will not reflect the intrinsic value or the growth in the value of the company. And that's fine, right? Because we're all long-term investors. So as long as you can find that company that can grow at that rate that which you want to grow your money at, then I think that's okay. From there, right, for example, if your annualized growth is 30%, then you need to start looking at your portfolio. Are your companies growing at that rate that you want to grow? So when I say your companies grow, I'm not talking about the stock price. I'm talking about the revenues, right? Are the earnings growing at the rate at which you want to grow your money at? Right. If it's not, then these companies will not be serving you in the long run.
When do you think is the next market crash or correction?
I think if I give you an answer, then you can please expose me for being a fake guru.
Yeah.
Honestly, no one knows. A lot of people think that investing is you just put a lump sum in and then you just let your money grow. But they forget that if you want it to be faster, you should inject capital, right?
Yep.
It's just like a savings account, right? You want to put money in and you just keep putting in every single month. And then if you're fully invested now, right, I think it is also okay, because think about it, right? Imagine, for example, Kelvin, like you're invested, well, you say 80%, right? Right now it's about 80% into Tesla. If a market crash comes, you don't have extra cash to invest in other things, right? But think about it this way, because if you really think yourself as an owner, right? So let's say you own 1% of Tesla, right? Actually, legally, right, you own 1% of the cash in bank in Tesla. Right, so in a way, even though you do not have cash right now in your portfolio, right, your cash is basically in a way transferred from your own personal portfolio to the company's bank account, right? And you ask yourself, during recession, right, can Tesla acquire companies at a cheaper price? Can Tesla buy materials at a cheaper price? Can Tesla bring in higher returns on that cash in bank, higher than you personally? I think for sure, right? Because think about it, as a company, Tesla is already 900 over billion, going to 1 trillion. They definitely have that negotiating power, right? To say that, hey, I want to buy over this company to gain that capability, right? And Elon Musk deploy your cash for you, right? And that cash may give you returns of more than 40-50%. As compared to you, yourself in a crash, you may not be able to structure or craft up private deals with other companies. When you start thinking like a real owner and you basically are just allowing Elon Musk to allocate your cash for you, right, then you will not feel so bad. Because think about it, right, if Elon Musk can really buy businesses or make acquisitions at cheap price, develop technology at a low price, right, even though the stock price will tank maybe 40-50% in the short run, because let's say if it's a great financial crisis, but during this period, because he's doing all these smart acquisitions, right, the intrinsic value of Tesla will grow a lot. So when the great financial crisis is over, right, suddenly it's like a compressed spring, right, Tesla stock prices will go back to where it's really value add. Right. I think by thinking this way, right, it will help me to stop being very FOMO or like think like, okay, when is the next crash going to come? It makes me very comfortable deploying my cash.
Your level of thinking is like a meme, like the head, the brain is the second level thinking.
And I can just add a more specific example. For example, I invest in Camplify. For every dollar of sales and marketing they spend, they're actually generating a very decent ROI. So can you imagine if a recession comes, companies cut down on advertising, but if Camplify aggressively spends on sales and marketing and people are stressed, they want to go on RV trips. I don't think it's hard to imagine we may have a very good ROI.
So if you are not planning for a market crash, how are you investing your money?
I always invest with the long term in mind. And then I'll ask myself like, will my kids be proud of my decision of investing into this company? Or will my future kids be proud? Right? When I start asking myself these questions, then this money is going to be for my kids' college education. Is this the way I'm going to handle this money? Or if this money, for example, is going to be for my wedding, or it's going to be for my partner, we're going to buy a house together, am I going to use my money like that? That will really help govern my decision making. Having a growth rate of more than 20% is a non-negotiable for me, because anything below 20% is going to take you around more than 20 years to hit $1 million if you start off with 10K and you inject maybe $400 to $500 every month.
Specifically, how are you investing your money?
I calculate the value of my companies. Okay. So for example, if there's a point in my portfolio where all the companies are overvalued in my opinion, even though every month I put money into my brokerage account, right, I'll just keep cash, right? And then I'll take advantage of put options. So I will sell put at a strike price where I'm more than happy to get exercise and to buy the company. So in a way, right, it's like I am buying a company at a cheaper price, and if I don't get exercise, I also earn money at the same time. So it's a win-win situation. It's kind of like I get to be like the house of the casino where whatever happens, I will still win in the long run.
Before we end, do you have any advice how to become a better investor?
I think at the end of the day, it's to stick with what you know, because I know a lot of investors, right, they actually work in, for example, the tech sector, right, software sector, and then what they did was they just bought shares of their own company because their own companies doing well, or they bought shares into other companies that they saw a lot of people using. So for example, I have this friend of mine, she works in Salesforce. She knew that Salesforce was doing well because every year you are getting more and more pay, you get bonuses. And then she also saw her clients using companies' software like Adobe, DocuSign, and that's where she started buying. So it was things that she could really understand because she was working in that industry, right? So if you are working in a certain industry and you see certain interesting things, right, I think this is where you can really invest in, and you also will have a peace of mind, right? Because you are working with this day in, day out. And for example, if you see clients not using DocuSign anymore, then you kind of have like early warning detector, right? Because you work in the industry. And I think more importantly also is to look at financials of a company. I think you don't have to really drill down super duper deep into everything, but I think there's this website called morningstar.com that I use. You know, just look at the simple basic stuff like, okay, is the cash flow negative, or is the revenues growing, right? I think just looking at these two things, you should be okay. Yeah, and of course the debt. Yeah, debt is very important. Yeah, I prefer to buy into companies that is low in debt because it's going to be very catastrophic if they go bankrupt. Okay,
we have reached to the end of this interview. Thank you, Jonathan, for joining me in this session.
Yeah, thanks for having me.
Yeah, if you guys haven't subscribed to him, you can do so because he knows a lot of stuff, obviously.
Not a guru.
Yeah, not a guru. Yes, we are all still learning. Okay, like, share, and subscribe as I'll be posting more videos every Monday, Wednesday, and Friday. Okay, bye.
Bye.